Well, good morning, Jagender Rana here. So the topic of discussion today is insurance frauds are rampant in India. Insurance frauds are rampant in India. The word insurance is a synonym for trust. It's a relationship of faith between multiple stakeholders onto each other, and only with that faith does the whole industry operate. So it all starts with a customer having trust in the agent and the insurance company that at the time of loss, when he will be needing the most, the insurer will come to his rescue and he state all his financial losses. Similarly, the agent trusts the insurers as they are the face of the company, and thus with the faith of providing an impeccable service, they sell insurance policies with confidence of indemnity to their clients. While India does have regulations and laws to address insurance fraud, many experts agree that there is currently no robust control system in place to effectively combat insurance fraud. With concerns raised about the lack of dedicated insurance fraud law and inadequate mechanism to penalize fraudsters, leaving a significant gap in preventing and managing fraudulent claims. So key points about insurance fraud control in India are that there is no dedicated insurance fraud law. India lacks a specific law solely focused on insurance fraud, making it difficult to prosecute offenders effectively. And there are limited penalties. Even with existing laws, penalties for insurance fraud may not be stringent enough to deter fraudulent activity. Data sharing challenges. While the Insurance Regulatory and Development Authority of India has introduced a fraud monitoring system, data sharing between insurers remains a hurdle in identifying and preventing fraud. Now, increasing fraud cases. Despite efforts by the IRDAI, the incidence of insurance frauds in India, particularly in health and life insurance, is on the rise. Why? Because the Insurance Fraud Control Act is the need of the hour. Insurance fraud is an unlawful act on the part of either the insurance buyer or seller. So insurance fraud by the issuer, that is seller, involves selling policies from fictitious companies, failing to submit premiums and implementing policies to create more commissions. Consumers' fraud may involve false claims, falsified medical reports, post-dated policy fraud, realistic fraud, fake death or abduction and murder. So fraud in insurance is an attempt to manipulate an insurance policy. Insurance is meant to protect against risk and not to act as a tool for enriching the insured. So while policy issuers, insurance fraud does happen, in the majority of cases it is done by the policyholder, seeking to get more money by exaggerating a claim. The more sensational cases are comparatively uncommon, such as faking a suicide or committing murder for insurance money. So the types of fraud in the insurance industry. The insurance industry is a conglomerate of more than 7,000 individual firms that receives more than 1 trillion premiums annually. It makes it a prime target for wide variety of illegal activities with a large capital flow through the industry. Yes, after banking, the insurance industry may be the second largest victim of fraud. How the frauds are committed? There are false claims. One of the most popular form of insurance fraud is to claim for an accident that never occurred, or had been staged, or had never been committed. So it happens in a variety of forms, often for several reasons. Slip and fall claims are perhaps the most common form of planned accident, as accidents are difficult to prove or falsify, and possible payouts could be high. So policyholders are in the scam in some cases, while in some cases they are innocent victims. If an automobile owner is directly in charge of their vehicle, they often damage their vehicle and report it as an accident. So then if they get a payout from the insurance firm, they either get the car repaired cheaply or they simply don't have it fixed. So homeowners may often sometimes make claims for suspected injuries or harm to property caused by themselves. So the form of false allegations such as arson is for harm that was not an accident. So in some cases, a building can be worth much less than it is insured for. So to make an insurance claim, the owner can employ someone to put fire on the building or set it on fire themselves. Homeowners who are upside down on their mortgage or company owners facing bankruptcy are other common causes of this form of fraud. Then there are inflated claims. Inflated claims can happen at any time, but in the aftermath of natural disasters, they appear to be most common. The area is almost always filled with scam fraudsters and hucksters seeking to make a buck off the insurance companies. If there is a natural disaster big enough to impact an entire country, so in some cases, homeowners may knowingly sign inflated claims for work that has never been completed. So many forms of routine home maintenance, such as roof repairs, are also ideal for false claim. So for certain cases, inflation does not come from work that has not been done, but instead the insurance provider is paid for high quality materials that are substituted when the work is conducted. Then there are disaster fraud. Chaos usually ensues in the aftermath of any natural disaster. It provides an ideal environment for a wide range of illegal activities. Owing to the high number of claims received, insurance firms simply do not have the resources at their disposal to go out and investigate every allegation. It is not common for a single home to be left completely impact right in the center of a ring of homes which are burnt, flooded, or otherwise demolished, or a car or other valuables to survive in perfect condition. So insurance firms typically depend on data to assess which residential areas and which non-residential areas are eligible for coverage. When a home or other property in an area of significant harm remains intact, policyholders can make claims that are often unnoticed payable sites. Then there are fake death. Faking death is such a common form of deception that in a wide variety of novels, movies, and television shows, it's also a standard plot point. The idea is quite simple. A policyholder will take out on themselves a large life insurance policy and then fake their death. If an insurance payment is earned by the beneficiary or beneficiaries, they ride off into the sunset with their allegedly dead loved one. So as in a lot of cases, they usually avoid the supposedly dead loved one and vanish into the sunset of their own with their generous insurance payout. And the next one is insurance company fraud. Not all insurance fraud is committed by policyholders or by policyholders being defrauded. Insurance brokers or companies are often committing a large amount of insurance fraud. Several of the more popular forms of fraud affecting insurance companies include premium diversion and fee churning. Premium diversion is perhaps the most common form of insurance fraud, and it occurs when insurance brokers or companies simply collect the premium of a policyholder rather than delivering it to the underwriters. So unlicensed insurance brokers will in some cases actually sell insurance, collect the premiums, and then refuse to make any claims. That is especially true with workers' compensation insurance due to the high dollar sums associated with the group insurance of the nature. So charge churning usually happens when an insurance provider constantly transfers a life insurance policy to different insurance agencies to get profit. Insurance brokers are credited for choosing the client's best policy, but they often switch the policy around to get a fee from various firms for themselves as brokerage. So when it happens, the policyholder's premium also go up, as life insurance is more costly when you age, and their coverage often goes down in many situations. So the problem with India's insurance firm is that they do not exchange data widely as banks do. That is the reason every insurance provider needs to rely on their system to find fraud. It is extremely critical that all insurance firms form a shared database and begin actively exchanging data about fraud. So many insurers only share a derogatory list, that is a list of consumers, distributors, and medical practitioners who have committed fraud earlier. Therefore, the system is reactive rather than predictive. India's insurance regulator has come down hard on insurance firms that deny claims. New laws were established in a state where an insurance provider has 3 years to find out if the data given at the time the policy was bought was inaccurate. So for 3 years the data are deemed correct and insurance firms are required to pay the claim. The problem is that the law punishes insurance companies but does not provide them with any redress. If insurance providers believe an individual attempted to commit fraud, they get away with very mild penalties. To stop fraud in an insurance sector, it is necessary to establish and enforce strict laws. Such laws should act as a deterrent to professional fraud or make a career out of insurance companies cheating. Insurance firms have started aggregating data on areas where insurance fraud is rife. It could be due to the problem of law and order in the province, or it could be due to the high number of doctors willing to offer fake medical certificates in a given region. Insurance providers have started refusing insurance coverage to people in some areas. They have also begun paying a premium if they don't reject this policy outright. But this, however, is not sustainable. Not sustainable. Across the United States, cases against this unfair practice called redlining have been fought. It's only a matter of time before legal action is taken across India as well. So the detection of insurance fraud generally starts with identifying suspicious claims that have a higher possibility of being fraudulent. This can be done by statistical analysis, referrals from claims adjusters or insurance agents. Also, the public can provide tips to insurance companies, law enforcement, and other organizations regarding suspected or admitted insurance fraud perpetrated by other individuals. Some of the insurers' most common method of tackling the frauds are investigation and verification of records for identification of the fraud. Knowing the potential for fraud can help reduce losses. Use of data analytics to identify fraud. running by a special review of any dubious assertions, use of the statistical analysis, and responsibility to provide private investigators. So the insured and potential clients are facing one of the greatest brunts of insurance fraud. In certain cases, fraud may also lead to delay in lawsuit settlement applications being denied. But it's hard to specify the time frame required to investigate the fraud because it completely depends upon the type of fraud, people involved, and relative potential of the fraud. On an average, it takes around 14 to 55 days to investigate a normal potential case. Unfortunately, there are cases which take far longer than this due to complexity of the investigation process. Each insurance company is needed to develop a fraud monitoring framework according to the IRD. The framework shall include provisions intended to shield, deter, identify, and minimize the risk of fraud from insurance company policyholders, claimants, intermediaries, and employees. Insurers are expected to follow a comprehensive approach to accurately define, assess, track, and monitor fraud risk, and ultimately develop effective policies and procedures for risk management. So the fraud monitoring function is required by each insurance provider as a separate vertical to ensure successful enforcement of anti-fraud policies. Insurers are responsible for educating both prospective and current customers of their policies to prevent fraud. Insurers include the requisite cautions in insurance contracts and related records, properly pointing out the implications of making a false statement and or inaccurate statement for the benefit of the policyholder, claimants, and their beneficiaries. One way of detecting fraud is to identify early detection causes. To identify causes for detecting fraud, the fraud detection feature must be instrumental in recognizing vulnerable and sensitive areas within their consumer associations. So there is the need of the hour. This is the need of the hour to provide legislation that will provide rapid redress against such fraud. Strict laws and strict penalties are needed in today's scenario for those guilty of committing such frauds, which will also serve as a deterrent to those trying to abuse this industry. Thank you very much.